As the year comes to a close, tax planning becomes increasingly important. By taking the right steps now, you can potentially reduce your tax bill and avoid surprises when tax season arrives. With just a few months left in the year, here are the top 10 tax planning tips that can help you maximize savings and ensure you're prepared for the next tax year. 1. Contribute to retirement accounts. One of the most effective ways to reduce your taxable income is by contributing to retirement accounts. For 2025, the contribution limits for 401ks and IRAs have increased, allowing you to contribute more. Traditional 401k and IRA contributions are made pre-tax, which reduces your taxable income for the year. Additionally, consider contributing to a Roth IRA if your income qualifies. Though this doesn't reduce your current taxable income, it provides tax-free growth and withdrawals in retirement. 2. Harvest tax losses. If you have investments that have decreased in value, you can consider tax loss harvesting. This strategy involves selling losing investments to offset gains from other investments. By realizing capital losses, you can reduce your taxable income, up to a limit of $3,000 per year, with any excess losses carried forward to future tax years. This can be an effective way to lower your overall tax burden. 3. Maximize tax-advantaged accounts. In addition to retirement accounts, there are other tax-advantaged accounts that you can take advantage of before year-end. For instance, health savings accounts, HSAs, and flexible spending accounts, FSAs, allow you to contribute pre-tax dollars for medical expenses. Contributing to these accounts not only helps you save on taxes but also ensures you're prepared for any upcoming medical costs. 4. Accelerate deductions. To lower your taxable income, you can accelerate deductions by prepaying certain expenses. For example, consider paying your January mortgage or property taxes in December to get the deduction in the current tax year. You could also make charitable donations before the end of the year to claim them on your taxes, or purchase business-related items if you're self-employed, all of which may qualify for deductions. 5. Review your investment portfolio. Take a close look at your investment portfolio to ensure you're on track with your financial goals and tax strategy. If you have investments that have performed well, you may want to realize some of those gains by selling them before the year ends. On the other hand, if you have investments that have underperformed, tax loss harvesting might be an option. This review will also allow you to adjust for changes in tax laws that may impact your strategy. 6. Plan for the child tax credit. The child tax credit, CTC, can provide significant savings for families, but it has specific eligibility requirements. If you qualify, consider making moves before the year ends that could maximize your credit. For instance, if you're close to the income threshold for receiving the full credit, accelerating certain deductions or income may allow you to remain eligible for the highest credit amount. 7. Contribute to a 529 college savings plan. If you have children or grandchildren, contributing to a 529 college savings plan before the year's end can be a great tax-saving strategy. While contributions to a 529 plan aren't deductible on your federal taxes, many states offer state income tax deductions or credits for contributions. This can be an effective way to reduce state tax liability while saving for future education costs. 8. Max out your health savings account, HSA. If you have a health savings account, HSA, consider maximizing your contributions before the end of the year. Contributions to an HSA are tax-deductible, and withdrawals for qualified medical expenses are tax-free. The contribution limit for 2025 has increased, so you may be able to contribute more to reduce your taxable income and prepare for future healthcare costs. 9. Take advantage of Dependent Care FSA. If you have young children or dependents, a Dependent Care Flexible Spending Account, FSA, allows you to set aside pre-tax dollars to pay for qualified child care expenses. This helps reduce your taxable income and saves you money on daycare costs. Be sure to check your balance, as FSAs typically have a use it or lose it policy, meaning you'll lose any unspent funds at the end of the year. 10. Review your withholding. If you've experienced major life changes during the year, such as marriage, a new job, or the birth of a child, it's a good idea to review your withholding. Adjusting your W-4 form before year-end ensures that the correct amount of tax is withheld from your paycheck for the remainder of the year. This can prevent underpayment penalties or help you avoid overpaying taxes, which means a larger refund next tax season. By taking action before the year ends, you can make a significant impact on your tax situation. From contributing to retirement accounts and HSAs to maximizing deductions and credits, there are multiple strategies that can reduce your taxable income and minimize your overall tax liability. To ensure you're fully optimized for savings, consider consulting with a tax professional who can tailor these tips to your specific financial situation. Planning ahead can make a big difference in your tax return and financial health.